Hey everybody, welcome to Trading Capital's daily analysis video here on June 9th, and lots to discuss today in the markets. Originally it was pretty quiet, flat day. We were range bound all day until the last basically 2 hours of the market. The markets saw some sell side pressure, and we will discuss many different things, many different charts. But first I want to congratulate you all for selling Chainlink. We banked just under 16% on Chainlink, so it's good to start now peeling back our long crypto positions, because I do think the markets are coming into that area where they could potentially start the next down leg as we are heading into economic data. We have an approaching FOMC meeting, so there's a lot of catalysts that could appear and send the markets for a downturn. But nonetheless, beautiful 15-16%. One of the reasons why I sold our Chainlink here is you're starting to run into this red bar resistance, and look at this volume that was traded there on Chainlink. So there's tons of volume that you're going to struggle to get through. We sold around the 925 level. It actually went all the way up to 966. So for those of you could have netted a little bit more than I did. You could have netted just about 20%, but nonetheless, 16% is a healthy gain in the crypto. So right now for our crypto positions, we're still holding Bitcoin long, and we're still holding Ethereum long. And I do think those are kind of lagging. Bitcoin's been more range bound. Ethereum has also been a little bit more range bound, but truly impressive to see Chainlink was the stronger one, showing the better relative strength in comparison to Bitcoin and Ethereum. But let's take a look at the S&P 500 here. What a sell-off late into the day. But just analyzing this price action over here. So this is where we gapped up and basically started selling off in the pre-market trading. And notice how we gapped up. You made this beautiful topping tail signal, intraday topping tail, and that was kind of your first clear point that this market was going to be in trouble today. And eventually, look, you just started selling. As the markets opened on volume, they caught a little bit of a relief bounce. But your second signal of the day was these two candles over here. So you had this impressive wide range green bar surge to the upside, and then look what followed. This bearish engulfing candle. So right away, that was a signal to me intraday that, okay, we're going to really watch these markets to see what happens here, because whenever you have a beautiful power move to the upside followed by an even bigger reversal, as a technical analyst, that triggers my brain to be on guard, stand on guard. And that's why you'll notice that we also took additional shorts on the market today, specifically around energy, which we'll go over in the coming charts. So notice after this bearish engulfing candle, you had a little bit of price action trying to recapture what you originally lost. You failed to do so again, had more selling, and then you found a little bit of support right on this trend line that we've been watching. You have this upsloping trend line connects to your pivot. So that was your line in the sand. You did not want to break that. You had a little bit of a power move right up until the selling commenced again. And then notice how you also had this beautiful power move to the upside, followed by yet again another bearish engulfing candle. So when you have two intraday bearish engulfing candles plus a topping tail, an intraday topping tail, that's showing you that the price action is showing many negative bias signs. And that's why you want to be on the lookout. And simply reading candle formations can be a powerful tool to analyze where the likely short-term price action is to go. Now, did I think we were going to dump this hard? No, I did not. But I did see that there was more negative bias to this trading session than there regularly is. So it's truly impressive to see how far we collapsed on the S&P 500 today. The S&P finished down 2.38%, the Nasdaq finished down 2.68%, and the Russell finished down 2.33%. So big cap tech was hit the hardest today. And I want to show you now, we've been watching, let me just flip to the daily chart. We have been watching this bull flag pattern for basically several days now, and the probabilities did dictate that a move to the upside was likely. And we did say that after 6 or 7 candle formations, you are likely to see a move happen. And honestly, this is why we accumulate short. This is why we are net short the market again. We were net long at one point, just basically a couple weeks ago after this rally. And this is why we have to flip our trading strategies back and forth, being net short, being net long, because the markets are going to whip you around, and you have to be able to trade around the key technical levels where the bounces are likely to occur, and again when the next down legs are likely to resume. So clearly now this bull flag pattern has been toasted. The damage is done. You did not want to see a a close below this line over here, and that's certainly what we got by a long shot. Not only did you close outside of this range now that we were chopping in for a week, you also broke the short-term moving average, which is this 25-day moving average, and you've closed below. So now tomorrow we'll set up confirmation day. Obviously, we all know that the CPI comes out, so that's a long-awaited number. And potentially with a good read, the markets can rally. But since the technical damage is done on a probability basis, there is a more of a chance that you head lower at this point in time. However, it's all going to hinge on what that CPI data is. So I'm not going to try to front run it. We are net short. I do think the overall macro trend, this larger trend at bay, will keep playing out the way it should, which is more and more downside. That's why we are net short. So I'm fine with these markets going down. I'm fine with these markets going up. If they go up, we'll just have an opportunity to allocate more cash to our accumulate more shorts on this market. But notice how here you filled this technical gap now. There was really no support there, which is pretty interesting to note. Basically no support there. And now it looks like you're going after this key technical gap around the, let's just see, the 397. So there's likely scenario that we could see further selling tomorrow, and then you could potentially see some sort of a, a downside move down like that, and then a retrace back up to, this original gap fill where you broke down again. So we'll just have to keep monitoring, but lots of technical damage done. This is why you have to continue watch candle by candle, because patterns can change. A couple days ago we were saying this is a bullish pattern, a bull flag is forming. It does favor a move to the upside, and today just completely negated that. So that just shows you the power of how patterns can change in the blink of an eye. And realistically, this pattern just changed in the last 2 hours of the day. It was still holding for most of the trading session until it wasn't. So that just shows you you can't be tied to one certain outcome, and we will just keep adapting and trading. And again, it's good to be net short as the markets fall again, because I do think they have a long way to go. Looking at the Nasdaq QQQ, same sort of thing. The bull flag is negated now. You have filled this key technical gap over here, which is really interesting in my opinion. So that might be a great tradable level tomorrow as we head into the CPI data. We get the CPI in the morning, 8:30, before the markets open, so there should be some clarity in terms of pre-market trading, which way the market is likely to go based off of the data. So clearly this long-term resistance line, which was support for a very, very long time, is now acting as a super duper resistance level. You can see here, price action has struggled on 1, 2, 3, 4, 5, 6 different times to try to get above there, and you could not hold on to that level. So just very, very interesting price action. Since the technical damage is done on the S&P and the Nasdaq, it does favor more downside. So just keep that in mind. More downside is likely to commence. There were a couple things that we did today. We added to our CGC. So I just want to show you the long-term picture of CGC here. So CGC, weed legal in Canada, just marked the exact top, which is pretty and crazy in my opinion. Massive speculation started over here. This is when you notice an uptick in volume. But this is the more recent price action over here. All the way trading at 56, you're now down to 385. That's an incredible drop on Canopy Growth. And it's just something that really, really blows my mind how these stocks have been obliterated. But what I want you to note is we have played, let me just take off these moving averages so it's not as confusing. We have played CGC now numerous times. So you can notice that we've had many different bounces. We had a 28% bounce here. We also had a little bit of a bounce here, probably about another 30%. We had a 40% bounce over here after a 57% decline. We had another 65% decline, which we played for a 44% bounce. So there's been tons of these bounces along the way that we have been able to trade and make a profit on. And this is exactly what we're doing again. CGC is now coming into this oversold levels. We have been accumulated. We added at the 392 level. One of the reasons we added there was it was this pivot high, this major breakout zone, and it should act as support. Your next level of support that we will likely add at is going to be probably around this level over there. Let me just change it to green. So probably around the 321 level, we will look to start accumulating more CGC. But the interesting thing now is you've been stuck in this range, and the degree of selling pressure has slowly been abating, as if you're starting to put in this rounding base formation. I think the mass capitulation has happened, and now people are starting to accumulate slowly, like us, for that inevitable bounce that will come. And the cool thing is that all it really takes is some chatter about legalization of marijuana. And with midterm elections in the States coming up, it certainly does favor that the chatter will begin sooner rather than later, which could send the stock soaring, 25-30% in one day, 40-50% in 1 week. And I do think the states are very, very close to legalizing marijuana. One of the next parties that I think basically the next federal election, you will see weed legal in the United States of America, which will be a massive, massive market. There's a poll that I read that now 88% of Americans support legalizing marijuana, both recreationally and medicinally, as opposed to 12% of Americans that don't. So clearly a massive, massive majority in favor of legalizing marijuana. So this is kind of the one that I don't even mind just accumulating at key technical levels. It's a rather small position, just 2% of our portfolio this far. I'm willing to take it up to 5%. So we have plenty of maneuverability to continue to add at lower levels and bring in our average at an amazing level that when that inevitable pop does come, we can easily cash out and make a double-digit gain on our CGC trade. But even at these levels, honestly, accumulating CGC for a potential longer-term investment is something that is still piquing my interest. Like I said, I'm fine holding this one longer term. You do have the outcome that Constellation Brands still owns a majority stake in CGC. So at these levels, you could assume that Constellation Brands could come in and outright buy out Canopy Growth. That would be the best case scenario. And that, I think, is a highly probable scenario, one that people are forgetting about who the major owner in CGC is. It's Constellation Brands, massive, massive, massive alcoholic beverage company, and obviously a marijuana company now. So it's certainly, there's a lot of catalysts that I think could work to our favor, and that's why CGC, I think, is a great longer-term accumulation plan. Another one we are shorting today is Synovus Energy, essentially gas, oil, minerals. We are in the money today, 24.44, but we can't get too excited yet because this stock has been on a tear. But one of the reasons we shorted this, and I just want to pull up a longer term time frame. So we're going to pull up the monthly chart just to do some long-term analysis. So the monthly chart is really, really incredible. I get so excited when I see resistance levels and technical signals that give us these entries. So right off the hop, we have a 1, 2, 3 pivot resistance. This is a longer term trend line going back all the way to 2011, 2012, and we just tagged that this month a couple days ago. So we didn't nail the exact top, but pretty darn close to being at the exact top. And one of the reasons I pulled the trigger on this short is because you're into this wide range red bar of resistance. You have this longer term resistance trend line. And on a monthly basis, you're on a time count. 1, 2, 3, 4, 5 months of direct upside. And when you flip to the weekly chart, you also have 1, 2, 3, 4, 5, 6. And now look what you're starting to put in. We were able to pull the short off before this weekly doji was in effect. And we were on a 1, 2, 3, 4, 5, 6, 7 week time count. This candle was green when we started, and now it's pulled off. So it's very, very healthy to see that these energy stocks could potentially be putting in their major cycle tops. And if they are, we are certainly going to profit tremendously from them. Another energy chart that we just looked over the other day was this XLE chart. I think you recall, let me just go to a longer time frame again. So if we go to the monthly chart on XLE, and again, we had this we showed this chart a few days ago, and we said we're into major resistance. These 3 major pivot tops, long-term resistance. It's just truly incredible that the charts guide you in the sense that you can find likely tops and likely bottoms. And when you have a massive move up like this in energy, as the economy is slowly starting to weaken, actually it's not slowly, it's weakening very, very quickly, I would say. And energies are notorious for having massive declines as GDP and growth decline alongside energy, because the one thing that keeps energy propped up is the demand. And if the demand slows, which it is, then it's good night for energies, even if there is a fundamental crisis of a short. Obviously, if people are changing their consuming habits, then energies are certainly going to take a massive hit. So we didn't short the XLE because we do have other charts that I believe are more extended and will pull in a little bit harder. This is obviously just a basket of energies, but it's just curious to know, look at this beautiful doji candle that would noted a potential top. You failed to confirm above that resistance point, and now you're coming in pretty hard. We did go long Carvana today. Carvana is one of these ones that are very intriguing and interesting to me. Look at this move all the way down from 376 now down to 23.24 in the post market. And one of the reasons we're buying is because you're right into this level of support. You have massive support down here on Carvana. We're trading almost at the near lows of Carvana, and I figure we have to start accumulating the short because we've played Carvana 3 times over the last basically 2 months, and we've banked profit all 3 times. And once again, we're now starting to trade Carvana at a lower average than all of the 3 other times we traded Carvana and made a profit. And first thing I want you to notice, we do have a descending wedge pattern. Descending wedge patterns are notorious and highly probable of breaking out. So most people would think a descending wedge is likely to break down. It's actually very likely to break up. So that's your first technical signal that I've been watching. And then if we pull up, I want to go to just a shorter time frame, the 4-hour chart. So if we pull up the 4-hour chart, you can notice that we also have the price action is declining, descending, but your RSI is inclining and rising. So this is showing a positive divergence. Positive divergences generally denote, they can't give you the exact time frame when that reversal is going to happen, but it's just yet again another signal. Whenever you see a positive divergence, that is bullish for the underlying asset, versus a negative divergence is negative for the underlying asset. And Carvana is seeing a positive divergence where the price action is sloping down, but the RSI is starting to pick up. So that is very, very healthy to see. If we just move these trend lines away so it's easier for our analysis, taking a look at the intraday basis, despite the markets falling in the last 2 hours, Carvana was a stock that started rising in the last 2 hours. So when you have the S&P falling and stocks going negative, but you have Carvana rising, that is an underlying bullish signal for the short term. And I love this stock because when you look up the short interest, and anyone can look up the short interest on Carvana, it is one of the most shorted stocks in the market. Over 50% of the shares outstanding are on the short side. So when you have 50% of the shares outstanding on the short side, it opens up the possibilities for one of the biggest short squeezes you could ever see in a specific stock. So if we get some sort of a short squeeze, this could send this thing to $30 no problem. $30 would be a magnificent gain from our level. Let's just see what that would put us in the money. So if it sent it to $30, that would be a 26% gain for us. So I'm confident Carvana is going to have that mean reversion bounce. When you have too many people and 50% of the people on the short side of the stock, you're naturally going to get some sort of a mean reversion bounce that is going to spook a lot of those shorts out. And wait till you see a short squeeze in this name. It's a low price name, and 50%, it's just mind blowing. If I was on the short side of Carvana, especially shorting at these near all-time lows or cycle lows in years, that I would not be sleeping at night, just in my opinion. Let's take a look at natural gas. Natural gas, wild price action. Essentially, you had that initial dump from the LNG terminal that exploded in the States, in Texas. There was a fire there, and they're saying essentially they're not going to be able to ship out any natural gas for 3 weeks, which is going to put a big toll on Europe. So since the supply from that Texas terminal is roughly 18% of the natural gas supply that Europe gets, Europe natural gas prices have shot up 30-40% today. And over the next 3 weeks, I do anticipate that it's going to give some sort of a respite to the UNG prices, because when you have 18% of the supply now being stuck in the US, it's going to force the US to use that natural gas for our own needs, which is going to help us, everyone in North America. I'm very saddened for the people in Europe, because their economy's in dire straits and this is the last thing they needed, but it does help our short position. I do think it will help our short position. And with 2 billion cubic feet per day that this Texas terminal is responsible for, over a 3-week period, that's going to account for roughly 90 billion cubic feet that is not shipped to Europe, and that's going to help build up our reserves here. So I anticipate the building season is going to accelerate over the next 1 to 2 to 3 weeks, which is going to be in favor for our short position. And one of the arguments I keep hearing is, there's a war in Russia. That's really the only bullish case I've heard for people, as to why they're going long natural gas. And I managed to have a chat with one of my institutional hedge fund investors who manages a hedge fund on Wall Street, and he finally sold his natural gas long position today. He was net long natural gas for 2 years, basically caught this whole move, and just sold it today, his UNG position. And when I was having this discussion with him, the only bullish reason they could say is because the supply for natural gas was being offset by the war. And I still have a very difficult time to wrap my head around that, because yes, there is a war, I'm not going to deny that, but when you analyze what the war has done, it has really all it has really done is changed supply routes around. It hasn't eliminated natural gas. Yes, the Europe was buying cheap Russian energy, but that Russian energy is still being sold in larger amounts to China, to India, to the Middle East. So it's not like Russia's natural gas has just disappeared from the market. And it's forced the United States to actually ramp up their natural gas production and supply Europe. And when you think about it, people keep harping on this war aspect for natural gas prices, but in reality, the biggest driver for energy and high energy prices is consumption, demand. And when you have falling demand, that's ultimately what's going to be the nail in the coffin for energy prices. And specifically, when you have the World Bank revising down global GDP by 1/3, when you have Canada GDP declining by 50%, when you have the States GDP set to contract, when you have Europe's GDP set to contract, when you have China's GDP contracting because of COVID and these zero tolerance COVID lockdowns, everyone's GDP is set to contract and declining in some sort of way, which is inevitably going to put pressures on energy. So with global GDP declining and set to contract in some sort of way, it does favor that energies will collapse very sooner rather than later. And one of the reasons I think natural gas has still been rallying is specifically part and parcel due to the EIA comments that they've been making lately. The EIA came out with an article today saying that natural gas demand is going to stay elevated for 2022. And one of the reasons people have been investing in natural gas is because the building season of the reserves is below the 5-year average and below last year's average. Well, when you look at it, what was transpiring last year in 2021 and in 2020, it was this lunacy of money printing. When you have this much liquidity flowing in the system, and specifically the liquidity over the last 2 years, it skews the averages. How can anyone be going off of a 5-year average when the last 2 years we have printed more money than the last 40 years? So how can you be going off of a 5-year average that is so skewed and dominated by fake GDP growth? So this is what I'm saying. Now that GDP is contracting and the money is being removed from the system, we're going to get a more true consumption numbers over the coming months and years. Instead, we're comparing what natural gas demand was as all of this excess liquidity and money printing has been going on. People need to expand their horizon and look at a longer average to get a more true meaningful picture as to how much how much of natural gas demand we actually need. And you cannot base an average on a 5-year period, and half of that period we were in the biggest money printing session of our human history. So that's just what kind of throws, that's just kind of what my headspace is at. I can't believe these people are still piling into energies and loading up. And yes, there might be some sort of a crunch, but in reality, the averages that we're going off of have been completely artificially elevated. And that's the thing. When you look at the stock market, when you look at the housing market now starting to contract, when you look at the bond market, you can't tell me that the economy is in the same state that it was last year and the same state that it was 2 years ago. Like, for instance, the EIA, I remember on this candle here, this gap up here, this was on the EIA's report saying that we had a record drawdown in 2021 on natural gas inventories. Of course we did. There was also record money printed that year. There were also record highs in the stock market. There were also record highs in the real estate market. So comparing the current natural gas inventories to one of the most speculative investment years in human history is just downright crazy in my opinion. So I do think natural gas will have its course and continue to come down. You can see on the UNG it did have an impressive reversal. Kind of have this new range that we're trading in. But I don't think you're going to get through this wide range red bar. I do think this is the interim top in the cycle. You have a key technical gap down here around the 2470 level that I'm watching closely. I do think that'll be a good level to exit our UNG short. I am going to hold our KOLD probably at the minimum to this, I believe it's 650 area on the actual natural gas chart. So over here it's 2250, give or take. But I do think as the economy contracts, we will head to the lower ranges, down over here. So that's just something that, sorry for the long rant, but I do think it's necessary for people to think about more than just a 5-year average and really dissect why are those averages so high, specifically over the last 1 to 2 years. It's because of the excess liquidity and money printing. So naturally, if we had the highest drawdown with the most amount of money floating around in 2021, and now we're withdrawing that money, we should have the biggest building seasons and the lesser demand coming over the coming years. So let's just be patient with our energy shorts, and I do think we will be rewarded sooner rather than later. Let's be on point for our CPI number tomorrow. I'm not going to try to guess as to what it comes in at. Obviously, if it comes in too high, it's going to be forcing the market to think the Fed is going to be a more hawkish Fed. If it comes in too low, then it does prime potentially the stock market to rally a little bit. One of the reasons we did see a late day sell-off in the stock market today is if you simply look at the US dollar, the DXY, look at this massive surge. So we are still short the dollar. We have a very small position. We will, via the UUP, we will continue to accumulate more UUP short in the event that it keeps going higher, but an impressive move in the dollar, and that's certainly a strong dollar puts tremendous amount of pressure on the overall stock market. So that's also a reason why we saw that late day sells, because we had a late day rally in the US dollar. That's it for today. Thank you all for being members, and be ready for the economic data tomorrow. It's truly an highly anticipated CPI read. There's lots of funds just waiting on the sideline, not knowing what to do, but it's kind of going to be that herd mentality flow. I think we're going to see a big move in either direction, and just due to the technical damage done on the chart, that direction may be to the downside if the CPI number comes in a little bit hotter than expected. Thank you.